Hi traders, welcome to this video. Today I want to talk about a trading edge or trading edges in general. I want to share some knowledge with you, some general knowledge about trading edges and what is a trading edge. But I also want to share some experience and also some insights from my own trading with you. So before we start with the video, please take a few seconds to read the risk disclaimer. So this is a video for educational purpose only. This video is no investment or trading advice. You are responsible for your own decisions, and you have to take responsibility for everything what you are doing in trading and investment. So this video is only to give you some knowledge, and it's only for educational purpose. Okay, let's dive into the topic. I say a trading edge is the reason why you make money as a trader. It can be expressed mathematically and measured objectively. When I talk with traders or read statements from traders about edges on social media, they always say that trading edges is something special, and I always have the impression that they think that an edge is something magically, but it isn't the case. And I assume that the most traders have no clue what their edge is and have no clue what an edge in general is. And I want to bring some light into this topic with this video. Let's start. I personally have a model in my head, and the model says there is a basic edge and there are additional edges. And the basic edge is the most important edge because the basic edge is the source of your profits. Without this basic edge, you don't have the chance to make any money. And you can see that the basic edge itself is always based on something, where I say it is a natural thing of the market. Here are just a few examples of basic edges. Trends. Trends and trend following in general is a very simple edge. I think everyone can use this edge to make money. If you look at the stock market or other markets in general, and if you look at the world in general, there are always trends, and there are always trends in every data and in everything what you can see and what you can feel in this world. And of course, in the stock market, you can see there is a trend on every time period, and the trend is built because people are not buying at the same time and also selling at the same time, and it is and there are trends because information has to be priced in, and it is not priced in 1 second or in one tick. No, it is priced in over time. And this is the source of trends. And the expectations, for example, about its stock and about a company, and people are thinking about the future growth of a company or the future growth of the economy in general. This leads to buy and sell decision, and this leads to trends in the market. And also emotions are a very big driver of trends. And if you look at stock charts, you see a second thing, and this is that price always tends to get back to something like an average. And this is called mean revision. So it is always going back after a time, going back to something like an average, or something like a mean in general. And this is something you can use if you, for example, trade mean revision systems, so that you bet that the price will go back to its normal thing, and that every trend which goes away from from the normal average or from the norm is something like an extension of the average itself. So mean revision strategies are, for example, used in sideways situation, but also in trends if you bet against the trend and trade a correction or trade a pullback. Speed is another edge, and I think speed is not something where you can benefit as a retail trader. If you think about speed, you can think about market making strategies, and if you think about market making strategies, you very quickly come to HFT, high frequency trading. And high frequency trading is something which uses the speed edge in extreme. Because technology is a big driver behind high frequency trading. And and if you want to use this edge, you must have a lot of capital and make a big investment in technology before you are the fastest trader in the electronic market. That was something completely different 20 or 30 years ago, where you also can stand in a pit and trade directly by screaming and shouting in a pit. And but today speed is something very difficult to build an edge on that. Don't think that you can build an edge around speed if you are a day trader or something. This is not what I mean here. I really mean being the fastest in the market, executing an order before somebody else have the chance to execute an order. To, for example, get the spread as a profit. Arbitrage is another form of an basic edge in the market, so that you trade, for example, two similar instruments or two similar commodities or options or whatever against, and only realize the difference if both similar instruments are priced differently. Or arbitrage could also be something where you play two similar or almost similar stocks against each other. So, for example, General Motors, going short General Motors and playing the long side in Tesla or something, where you bet that one of the stocks will perform better as the other one, and in that case, it's not a typical arbitrage that from, for example, trading silver on two different stock exchanges, but in that case you see both stocks as car producers, and both stocks have maybe a very similar production or something, and then you bet on both stocks in that case. Insider information or information in general is another edge. Insider information is one very, very big edge, because something which nobody knows, and it's forbidden, so it's a crime. But information in general can also be an edge. So, for example, if you have deep knowledge about one industry or about one sector or something, this can give you an edge, and you can build on it. Then another one is statistical patterns. Statistical patterns, I mean not chart patterns, but I mean something like if you buy on Fridays, in 80% of all Fridays, you will have a profit. So that's what I mean by statistical patterns. Or on the other side, if you go more deeply into data mining or something, you can also find statistical patterns in other data like weather or like economy things or whatever. So really finding patterns in data. But the problem with statistical patterns is there are millions of data mining companies, and there are millions of companies which have a very deep knowledge in finding patterns and data. And I think personally that this edge is very thin. So that means a lot of people recognize that, a lot of people search for the patterns, and it's very hard for retail traders to get the knowledge and to get the skills to find those patterns. So if you as a retail trader, as a normal trader, look at that, I personally would say the only edges where you can apply a trading system on and which you can use is trends and maybe mean revision. I use trends. Trends is a very simple way to make money at the stock exchange and also in forex or commodities or whatever. And it's a very basic thing, but you can build very successful trading strategies on this edge. Another thing which is very important is every edge or every basic edge must be combined with money management. You can have the best edge in the world, but if you let your losses run, and you will have losses, you kill every edge. So you can trade the best trends, you can make 1,000% on a stock, but if you let the stock go down 100% because the company is bankrupt or something is wrong with the company in general, then you lose your edge. So you must limit your losses. And money management is the key. Money management is really the key to bring this edge to life. So, and that's why I wrote here, important, the basic edge must be profitable, and you must apply a money management strategy or risk management strategy. Otherwise, you really kill all your basic edges. One of the questions I stumble upon in social media, and I sometimes get this question also via email, is a chart pattern or has a chart pattern an edge? I think this is very difficult to answer, because if you do research on chart patterns and you maybe compare 1,000 chart patterns, you will find that the chart patterns itself has something like a success rate or something like a win rate. But I never saw any reliable study on that where you can say, okay, a chart pattern like a head and shoulders or like a cup and handle has a success rate or win rate, and you can use that for trading. I personally think that a chart pattern itself is only one part of a setup. And a chart pattern has a very high dependency on other things, like the market situation, like the entry point you use, like the exit point. Sometimes you also include volume behavior if you look at a chart pattern. And I personally think that the setup itself, when you include all the different points, the setup itself can have an edge or can give you an edge. But I think the chart pattern itself has no edge, because it's also, it cannot, or a chart pattern cannot be measured 100% objectively. It is more an art as a science. So if you ask 20 traders and 20 traders look at a cup and handle pattern, they always interpret it a little bit different, and that makes it very difficult to make a study and see if chart pattern has an edge. So for me, my personal definition is no. I think chart patterns have no edge. But if you combine them with different other things like the market situation, entry point, exit point, and also a lot of other details, then a chart pattern can give you an edge. But then we don't speak about a chart pattern, but we speak more about a setup. Another very important point is we spoke about basic edges. And now we come to additional edges. If you take a basic edge like trends or like trend following, you can apply multiple additional edges to this basic edge to increase your overall edge. Sounds a little bit complicated, but it is very simple. So if you have, for example, if you say my basic edge is trend following. So I look for trends which give me the opportunity to capture big profits. Then you can apply, for example, stock selection criteria. You only look at a handful of stocks. You can apply market filters. So you can say, okay, I only trade stocks in a trend when the general trend of the market is up. You can apply timing criteria so that you say, okay, I, for example, only buy when the price is less than 5% above the base, or you can say, okay, I only buy when the general market is coming out of a correction. These are timing or entry tactics which you can use. Another thing is, for example, an entry tactic to go into a stock position, not at once, but in multiple steps. That can give you an additional edge. Exit tactics. So, for example, if you apply a trailing stop, or if you apply a special tactic in when you see an exhaustion run or something, that can give you an additional edge. Risk management is an additional edge, and also a very important one. Risk management is not only about stop losses, which we discussed with a basic edge. No, it's also about how you manage risk when the position is extended, or when, for example, you have multiple positions in your portfolio with the same or belonging to the same industry. So this is also risk management. Then research can give you an additional edge. This is very similar to stock selection. But if you know a lot about an industry, or if you know a lot about a stock, that can help you to select more or better companies which maybe have the higher chance to produce better trends. And of course, one additional edge is experience. A lot of people underestimate that. So if you're doing the same things for 20 years and you build up a lot of experience, you can use that to increase your edge. And because you tweaked your process, you improved your process, you improve your stock selection, your market filters, your entry tactics, and your risk management over time. And this gives you an additional edge itself. When we look at this pyramid here on the right side, there is the basic edge, for example, trend following and money management, and then the additional edges. But very important is that the additional edges can only build on a successful basic edge. So the additional edge has no impact if you have no basic edge and no money management rules. So you need that to bring the additional edges to life and to increase your edge with additional edges. And another thing, the number of additional edges is not so important. So it's not important that you apply 100 additional edges or 50 or whatever. That's not important. The more important thing is that if you apply an additional edge and you discover an additional edge and you test it and you want to apply that to your trading system, it's much more important that the additional edge has an impact. That's what's important. And a huge impact, Otherwise, you can drop the additional edge. So, for example, if you apply an additional edge and you discovered them by backtesting or by going through charts, and you test that and you see, okay, my overall edge is only increasing very, very little, then maybe it's better to not include that additional edge into your trading system because it makes your trading system more complicated. But if you test another additional edge and you see, okay, that has a huge impact on the overall edge, then it makes sense to include that into your trading system. So additional edges are important, definitely, but you must make sure that you have a basic edge. And the basic edge itself must be able to make money. You must be able to make money with your basic edge without any additional edges. This is important because additional edges can only improve and can only increase the overall edge, but they will not make money alone. So you cannot make money with stock selection or with an entry tactic or whatever, but you can make money by following trends. This is very important to have in mind when you look at edges. Another thing is, and I see that in many emails and a lot of Twitter comments, etc., that people think that mindset or trading psychology is an edge. And that's absolutely wrong. It's, if you have the best mindset of the world and the best mindset you can get as a trader, you will not make any cent. Because the mindset itself is only a way and only a tool to bring your general edge to life. That only helps you to execute your trading strategy as best as possible. But your mindset will not help you to make any cent. You can have a great mindset and you can execute a trading strategy 100% perfectly. But if you have no edge, then it will not help you. So this is something you must really have in your mind when you look at mindset work and trading psychology. The goal is to develop a mindset which allows you to execute your strategy without any obstacle. This is the only reason why we work on our mindset. We want to fully realize our edge. We want to fully bring the edge to life. This is what we try to do with mindset work. It's not that mindset work will help you to make any cent, or this is not an additional edge or something. It's only a framework to help you to realize your additional edges and basics. I repeat that over and over again because so many people are thinking that psychology or something is an edge in the market. That's wrong. Trend following is an edge, and trend following system with great entry and exit tactics and maybe stock selection and market timing, etc., etc. These are edges. You can measure that statistically and mathematically. And then you come with your mindset and say, okay, I have the right mindset to fully realize these edges. That's what's about it. All right. Another important thing you must have in your mind and also in your spreadsheets is the expectancy value, because the expectancy value measures your edge. You can measure your edge mathematically, and this is very simple. You can see that here in red. Expectancy value equals win rate multiplied with average profits minus loss rate multiplied with average loss. This is the expectancy value. You can apply this formula to a lot of different situations, like gambling, like stock market, like whatever. I will give you an example on the next slide. And if you look at the examples here below, you can see that also trading systems with a very, very high hit rate, the second example, with a 90% win rate and an average profit of $100 could be a losing strategy. Because if you do not control your losses, and this is the second part of this formula, so the 10% multiplied with 1,000, that means in 10% of all your trades, you make a loss of $1,000 on average. In that case, your strategy is not profitable. And if you look at the third example, and you see, okay, in 20% of all trades, I make $5,000 on average, and on 80%, I lose $750. So this is a strategy where you only make money in a very, very little number of trades. So this is a trading system with a very low hit rate, and I'm very sure that not so many people are able to trade that, because it's really, really hard to lose so much. But this strategy is the most profitable from all of these three. So you can see that also trading strategies with a very low hit rate can be very profitable. And one tip I want to give you is track your edge in a spreadsheet. So if you have a spreadsheet with all your trades, include this formula at the bottom and update the formula after every trade. So you get a better feeling if you have an edge and how your edge develops over time. But one thing you must make sure is your sample size must be large enough. So I personally recommend at least 200 trades, and then you can see, okay, do I have an expectancy value or not? I said that already on the slide before. I want to give you an example where expectancy value is applied on an example outside the trading world. And I personally, when I think about expectancy value, I always have an outlet store in my mind, because it's a very simple examples. You know, people are walking into an outlet store, and some of them are buyers and some of them are only walking to the outlet store and do not buy anything at all. So, and you can apply the same formula here. So you can see that maybe 10% of all people who are walking into the outlet store buy something for $100. Only 10%. And this is a very high number for outlet stores. By the way. And 90% of all people are walking out of the outlet store without buying anything, but they produce costs. They produce costs because people are working in the outlet stores and they need a salary, there is electricity costs, etc. So everyone who walks into an outlet store produced a loss, a small loss. But in that case, you can see the 10% of people who are buying something for $100, they make so much money for the outlet store that it really wipes out the losses from the 90% of people who walk out of the outlet store without buying anything. So in the end, you have a very, very thin edge, only $5.50. And that means every customer, nevertheless, if the customer buys anything or not, is worth $5.50. So, and the more people are coming into your store, the more money you make. And this is the same thing with trading. You know, it's really the same thing with trading. If you have an edge, and let's go one slide back. If you have an edge, for example, of $100, the first example, that means every trade you take, and it doesn't matter if this is a winning trade or a losing trade, will make you $100 in the long run. Not the single trade will make you $100, but on average above 200, 500 or 1,000 trades, you will make $100 per trade. It doesn't matter if this is a winning trade or a losing trade. Or in the example of of an outlet store, it doesn't matter if this is a customer who buys something or not. In the end, you will make $5.50 on average per customer which enters your store. I hope this helps you a little bit better to understand that what the expectancy value is. So have in mind people coming into the outlet store and going out of the outlet store, and some people are buying something and the most people are not buying something. So winning true trades versus losing trades, and overall you make money. That's the magic behind that. But also what you have in mind is, or what you keep in mind, you must have enough opportunities, because there are small and there are big edges. We saw that with supermarket, very small edge, only $5.50, but there are so many people coming into the supermarket or outlet store that overall there are thousands or millions of opportunities per year to make money. And this is what you can see here in the first example. If you have 1,000 opportunities per year, and with every opportunity you make $10 on average, you make $10,000 per year. If you only have 5 opportunities per year, and you make on average $1,000 per opportunity, you make only 5,000 per year. So that means a trading strategy with a smaller edge can make more money in a year because you have more opportunities. That means if you can take more trades. If you have a trading strategy where you can take 200 trades in a year, for example, you have more opportunities as with a trading strategy where you can only take 5 trades in a year. And 5 trades is only a very, very small number of trades. So I personally, for example, I take around 200 trades per year. So, and these are only the full trades without any partial buying or selling. So 200 trades per year. And this is a number where I say, okay, this I can apply a formula on that, and I can see if I have an edge or not. But if you are a long-term trader or long-term investor or whatever, you only have a very, very few opportunities. And this makes it very hard to measure if you have an edge or not, because your sample size is so small. So what you must keep in mind is the edge itself is only one component. It's also important how often you can repeat your edge. And again, a small edge can be very profitable if it's repeated very often and you have a lot of opportunities to do that. So now we come to one very important part and how to find an edge. And I want to tell you a little bit about my personal story. And you know, I traded for more than 10 years. And I started trading I get interested in investing or whatever, mutual funds and ETFs, etc. when I was 16 years old. And this is 19 years back or 19 years ago. And I discovered my edge over time. I wasn't a trader who sits on a PC and applied 1,000 back tests and whatever. I'm not a mathematically and statistical person. You know, I'm more a visual guy, and I love charts and I love to research companies. And what I did is I discovered my edge over time, and I took a lot of parts from other traders and put them together and built my own system with that. And I personally think this is a method which you can also apply as a retail trader. So you can take an existing time-proven and tested strategy as a basic edge. One example is only William O'Neill's canceling system, but maybe you can also find other existing trading systems and trading edges where you can build on. So I personally, for example, I took parts from William O'Neill, but I took also parts from mentors I followed, and I saw how they are trading and applied those rules and those strategies also, and include them into my trading strategy. And I backtested them all, and I backtested them very simple in a spreadsheet. I go through thousands of charts, and I go through thousands of my past trades and see how my trading system reacted when I changed something. This is a lot of work, but this gives you a much better feeling of your personal edge. When you see, or when you find a time-tested and proven strategy, you must first get familiar with the strategy and do your own testing. That's what I say with this manual going through charts and write all the numbers down in your spreadsheet, apply different filters on them, and apply different entry and exit rules. You can all do that with a very simple Excel spreadsheet. It takes a lot of time, but you can do that. And the goal is really to become more confident with the rules and to see that you have an edge when you apply all your rules and all your filters and all the things in the right way. And then it's more about adopting this trading strategy and fitting that to your personality. And for that it is very important to know what you like and what you do not like. So what it's easy to execute for you and what not. So for example, if it's really hard for you to follow a trailing stop, maybe a trailing stop isn't the right way. Maybe you are more a person who can include take profits in your trading strategy, and then you backtest that. You backtest that in a spreadsheet and see, okay, how or what is the outcome when I apply a fixed take profit instead of a trailing stop, and you can see if it increases your edge or decreases your edge or whatever. And when you have a very similar result, then you should go with something which is easy to execute for you. Adjust your strategy to your own circumstances and personality to make it easier to execute the strategy. This is a very important point. Not every person wants to be a full-time trader. I personally don't want to be a full-time trader at the moment. So because I like my day job and I like to do multiple things at the same time. And I know that a lot of people who want to become a successful trader do not want to spend all the time with that. And this is absolutely okay, but you must fit the strategy, and you must fit and you must see if you have an edge in those circumstances, or you must adjust your strategy to those circumstances. And of course, the last point, master the last obstacle with mindset work. This is really the last part you should work on, because you can work on your mindset, but if you haven't done your homework regarding the basic edge, regarding the additional edge, regarding adjusting the strategy to your personality, all the mindset work will not help you. So you must make sure that you did your homework, you did the basic things, and then you can see how you realize the edge and how you can be a very successful trader with mindset work. And again, if I look back at my trading career until today, it was a journey with a lot of ups and downs, like every trader has, But I worked continuously on improving my edge and testing new things and leaving out things, etc. And then if you find your way, you want to be very consistent. And consistency is something you reach with mindset work. But this is only one of the last steps here. Okay, so now this is the last slide in this presentation. I know it is very, very hard stuff, especially for beginners. So I recommend to watch this video multiple times and maybe also do more research about this topic. And with this research, I also can recommend some books. Of course, my personal Bible, or the best book I know in this genre, is How to Make Money in Stocks from William O'Neill. So this is, it's a trading system which gives you an edge, and then you can apply that to your personality. But there are also other books, Unholy Grails, and all the work from Nick Raj, for example. He published multiple books with tested trading systems, and you can use them. And you can use them as inspiration, or you can use them as a foundation to work to build your own trading system. Another book I read and I learned a lot about trading systems was from Thomas Dritzman, Trading Systems That Work. Very statistical, very mathematically, but you learn a lot about edges and you learn a lot about technical trading systems. And there are also trading systems included in this book which you can use for your own trading. Definitely a recommendation. And the last one I recommend is Trend Following from Michael Covell, because in his books, or in this book especially, he describes a lot of systematic trend following funds, CTAs and hedge funds. And you learn a lot about being very consistent in what you do over years and years and years and years. And you learn also about edges and what happens if you apply this edge consistently over years with a trading strategy. I think there is also an example trading system included at the end of the book, but I personally think more the value of this book is about seeing how CTAs and hedge fund in the trend following genre work and build as a success. Okay, to sum it up a little bit, know your basic edge. The basic edge is the foundation for your trading success. Apply additional edges on top of the basic edge. See if the additional edges have an impact on the overall edge or not. Calculate the expectancy value to make sure that you have an edge over time, and update this formula with all of the trades you are doing. And then to bring your edge to life, do a lot of mindset work. And mindset work only to help you to fully realize the edge, to execute your trading strategy without any interruption or without any obstacle. And so we are now at the end of the video, and again, I know it's very theoretically and it's very hard stuff, so it makes sense to watch that. You can also write me an email with questions or a comment here in YouTube, and I will answer them. And you can follow me on Twitter. You can follow me on YouTube, of course, and Instagram, Facebook. But I personally recommend my free newsletter. I send that out every Sunday with trading tips and some stocks from my personal watch list as an example. And you can subscribe to it for free and receive it every Sunday.